right? Or you go take the real one. So, anyway, and of course you can choke and you can let up and you know, you can get senioritis or junioritis or whatever you want.
So I just have one question on what's the purpose of EPBO, like the expected pension benefit obligation?
What's the purpose of it?
Yeah, well, when I was calculating this, I didn't know like what I had to do like with it.
Which problem are you on?
On 7. Yeah, it was on 6 too. I was just confused as to.
Yeah, what did you do with that?
Yeah, I just left it out.
Yeah, just ignore it. And throw stuff in just for fun.
That's what I figured.
Yeah. Okay. And expected, what's the APBO? Accumulated, yeah. Then the expected is what they think they're going to pay. But we don't, remember, we don't do anything with that, right?
I think, yeah, it said something about service costs comes out of there, or maybe it was interest costs. I don't know, I have to look at it anymore. Good already.
Did you calculate interest cost for that? I think it was a debate about whether or not, that's how much we think we're really going to pay, right? But we're not, we don't book it yet.
Okay.
Being kind of still aggressive, hiding the true cost. Or I think that's where you're at now. Yeah. So those were just red herrings thrown into Garage, I guess. Okay. So did you actually get this thing to work?
I think so, yeah.
God. So is it different every time, or did you do exactly the same thing with last time?
Pretty much the same thing.
Okay. I need others.
I muted the computer sound so it didn't get feedback. So.
Well, that was part of the problem. But
the microphone's going.
How'd you get it around the whole thing?
Just, I don't know. Just let me in the building.
I
hit the select area to record. It popped up a small.
Yeah.
And then I just drug it.
And it let you drag it. I couldn't get it to drag it on there or on here. It was set there and look at it. Okay. Yeah. I gotta get trained on this thing, I guess. Okay, so you're not recording yet, I suppose?
Yeah, I started.
You are, okay, all right, we're going. All right, good. So, should work. All right, let's get, now if I minimize this thing, or, well, yeah, I have to minimize it, I guess. It should not go away. And if I go out into Moodle, it should not go away, right?
Right.
All right. I bet it'll work for me again tomorrow. Just setting to stay there. One good thing is, until the final, you won't have to do pensions again and leases again, right? That's the good thing. Yeah, they're fair. But at least they're done fairly early in this class. And ordinarily they're at the end of the second intermediate, after everybody's burned out. Faculty don't get to them. So I like our doing 211, 312, and 313. And I'm debating with myself and the dean a little bit about how we should approach that in the future. We'll see. So we are on chapter 23? 24. 24. Last one, that's right. I don't need this, right? Just go away.
Yeah. Yes.
And this did not kill the rest of the stuff. So if I pull this across, it should still be there. And if I get rid of that, it should be behind it. If I pull up untitled, there. Good. Good. And then do not open this thing.
Is it supposed to have the green little lines?
It's already started.
It's supposed to be out there. If it's not, we'll find out. Actually, I usually show the two of them side by side up here, and it's not that way.
We can have to restart, stop recording, start it again, make sure.
Yeah, we'll just leave it, see what it does. See what it gives us. Maybe it's recording them both and not showing it on the screen. That's possible.
Yeah.
Yeah, okay. You think so. All right, good. So, let's take a look at this one. And I put it right over the top. Put this somewhere else. Okay, if you do not want to do that, you just want to go down. Okay. Yeah. Do it this way. I'm probably on the wrong thing here. Yes, again. That. Come back. There we go. All right. It worked. Okay. So full disclosure. You know, throughout the entire book, throughout everything you've done in accounting, we've been talking about full disclosure anyway. What do we mean by full disclosure? We've talked about it over and over and over, and it's showing you all the disclosures in all the different areas. And this is a chapter sort of reinforcing that and talking about the notes a lot, right? Disclosures that are in the notes. What do we mean by full disclosure?
Disclosing like all information data, like for the financial statement.
Disclosing all?
Well, if it's individual.
Okay, anything that would make a what? Because we got materiality in here, you don't disclose things that are not material, you only disclose material things, right? We have usefulness in here, right? You know, are the financial statements useful for what? Predicting future cash flow, decision making about investing or lending, right? Going to work for the company for that matter, you know, selling things to them, buying things from them, or going to work for them, selling your time to them, right? And so doing business with them, right? So what? You're going to predict future cash flows, and the uncertainty of those cash flows, over and over and over. Right? Okay, so when we talk about full disclosure, we are giving people the information that would be useful in making those decisions, right? So how much information is the real question, right? Full disclosure doesn't mean telling everybody everything. That would be impossible. You can't possibly put a picture of every single sales invoice they have and purchase invoice they have for the entire year in our financial statement. It's not going to happen. So and we're not even going to list all the accounts they got in their general ledger. It'd be absurd for a large company, right? Thousands of accounts. You're not going to do that. So how much detail are you going to give, right? How much information are you going to give? So when we talk about full disclosure, it's all the information that what? A reasonably informed decision maker would expect to be available in the financial statements to make informed decisions. That's it, right? Okay, that would be useful to them. And we're constantly balancing that because if you give people too much information, what happens? It's not information anymore, it's just data then, right? Information overload, right? So your brain just fries. A lot of people think that's where we're at on financial statements. How long are financial statements for a publicly held company? Oh man, 100 pages of intricate detail, right? All kinds of information they might understand or might not understand. And I think probably the vast majority of people that might read a financial statement do not understand a lot of it, right? So who's it directed to? Maybe analysts that are analyzing the company would really understand that information, be able to use that information, or somebody who's very, very familiar with the company doing their own investing perhaps, right? Or maybe management of the company, working for the company, but they're not using the notes to find that stuff out. They're writing the notes, right? So they already know what's in the notes, of course. So there's a lot of debate about, you know, exactly how useful is this information? Do we leave out information that might be really useful for making decisions and put in a whole bunch of information that maybe isn't being used? Because it's required by GAAP. You could ask that question too, right? How much detail do we really need? And is all this information really useful? Is somebody using it to make some sort of decisions? So anyway, yeah. When they talk about this thing, then where is the disclosure? Well, tons of it is on the face of the financial statements, right? Even more is in the notes of the financial statements. Is the information in the notes of the financial statements less important than what's on the face of the statements? I don't know. What if they have a massive contingent liability? Do we ever show those on the face of the statement? Yes. If what? It's a loss. Gains we typically would not, because it hasn't happened yet, we're gonna be conservative, so if it's a loss, and it's measurable and probable, right? So if it's a lawsuit we think we're gonna lose, probably we already lost it the next year, we go ahead and book it. If it's an IRS audit, and we think we're gonna be slammed with a big judgment against us, right? We'll go ahead and book it after they've already done it, right? That's what's gonna happen. And if it happens in the next year, and you're still finishing up the year, you'll probably book it. Or if you're really pretty certain it's gonna happen, you go ahead and book it. But it's gotta be probable, huh? What if it's only reasonably possible? When I talk about contingencies, what about that? If it's only reasonably possible, what do you do? Put in the notes of the financial statements. How important is it to read the notes of the financial statements? How about for Volkswagen right now? What do you think? They don't have any idea how big their losses are gonna be. How about for BP and when they had the oil spill, right? Oh man, the notes. How about Firestone? When their tires were on a whole bunch of Ford SUVs and the SUVs were having tires explode and the SUVs were rolling and killing people. That happened too. Okay, you know, what's the deal with this stuff? Okay, or GM with their, isn't it GM with the ignition thing? Right? You know, cars are killing people, right? You know, how much is gonna be your claim against the company for these things? Okay, in general. So all those sorts of things. So we'll talk about these post-balance sheet events, right? You know, things that should be disclosed. What about a post-balance sheet event? It happened post-balance sheet. So should it be in the financial statements? Maybe, right? I don't think it's really a post-balance sheet event. It should be in the financial statements. I think it really happened before the balance sheet date, and what? You found out about it later. Okay, the resolution was later. Okay, so you go ahead and book it, right? What if something is truly after the balance sheet date? It probably shouldn't be reflected in the statements at all, right? But should it be disclosed? Oh, we have one manufacturing plant and the thing burned to the ground. Should we maybe tell people? Like, you know, we're out of business now, right? Later. Might have something to do with going concern. Okay, so, sure. So you have a variety of things. Nope. Do it that way. This way. Good. All right, there it is. Calls for the full disclosure principle calls for financial reporting of any financial facts significant enough to influence the judgment of an informed reader. Whatever that means, okay? So if you get it on the CPA exam, what are you gonna say? That. Got it, just that. So, you know, financial disasters at different places highlight the difficulty of implementing the full disclosure principle. What was WorldCom's financial disaster? Oh, we're a complete fraud and we don't exist anymore. There's a good one, right? Okay, pretty much. Actually, they did still exist. They actually owned some pipelines, some oil pipelines. There just wasn't much left, right, before they liquidated the company. Lehman Brothers, what was the deal with that one? Investment firm, investment banker that ceased to exist. Survived, no, it's good, right? Yeah, ceased to exist. From really, really wealthy to non-existent. So yeah, so sure, you have a real problem in those situations. Take out your crystal ball and guess if they're going to continue. Okay, so all the places where you put it, these are, you know these things, I think. Basic financial statements, we know about balance sheet, income statement, cash flow, statement of changes in stockholders' equity, equity statement. Okay, in the notes, the first note is called, you can either number note 1, or it can have no number at all. They just label it as what? Significant accounting policies. Now, what would go in that note?
Inventory method.
Maybe your inventory method's an example. Typically, what would be there? We are making choices among competing GAAP. So GAAP allows different inventory methods, FIFO like, right? Okay. GAAP allows different depreciation methods, straight line, you know, declining balance methods. True? So where there is a choice that you're making, you need to tell people the choice you made. Pretty straightforward, isn't it? Okay? So I'm going to tell people where I made a choice, and I'm going to put that in my summary of significant accounting policies. Will I typically have numbers in that note? Now, you know what? We could pull up a few financial statements right now, and we find a whole bunch would have numbers in the summary of significant accounting policies. But the idea is what? You tell people what your policies are, you don't give them the details supporting the numbers in the financial statements or additional information about transactions, about numbers. That makes sense? So the summaries, so if you're doing it on the CPA exam, tell them, yeah, we're going to tell them what the accounting policies are in there, where I'm making choices. Do you tell them every single accounting policy? You know that you always have debits on the left and credits on the right. I don't think you have to tell anybody that. Everybody knows. So if people are, if everybody's using the same gap, don't bother, okay? So there's no reason to do that stuff. Otherwise, imagine how long that note would get if you told them everything you do. So you don't. Okay, types of things you might have, contingencies. They say inventory methods. That could either be in the accounting policies or maybe what you're going to be doing is you're going to be showing them balances. Oh, this is the other thing. Where can you show things in financial statements? One's on the face of the statement, right? What else? Parenthetically on the face of the statement. What's an example of parenthetical disclosure?
Accounts receivable, net.
Yeah, accounts receivable, and you put in parentheses, parenthetical, net of allowance for doubtful accounts, and you just show the net amount, you don't show the gross amount. That's parenthetical disclosure. Do you have to have the brackets around it for it to be parenthetical disclosure? No. It's still called parenthetical. And I've seen that on the CPA exam, by the way. They actually ask questions like that. Where would you put it? Okay, so that's possible. You could have it on the face of the statement. You could have it parenthetical on the statement, right? What else could you do? You could put it in a note to the financial statements. So, for instance, on this inventory one, what could you do? I probably would say my inventory method in the accounting policies. That's kind of funny. But I might have an inventory note, though I bet I would. What would I show in the inventory note?
What you're changing to.
Did I change? If I changed it, well, I could. If I changed my method of inventory, you know, change an accounting principle, going from FIFO to LIFO or vice versa, I'd probably have a note for that. So certainly changes in accounting principle, I bet you have a note for every single one, right? If it's not material, you don't treat it as a change, right? If it's material, it's material. You can disclose it. What else though on inventory? How about if I just show one inventory number on the face of my statement and then I show raw materials, work in process, and finished goods, or whatever my categories of inventory are on a note? Could I do that? Sure. What's the alternative to showing the detail in the note, in other words? You could have one number for accounts receivable, and you could have all the different kinds of accounts receivable in a note if you felt like it. That'd be fine. Okay. What else could you do? Instead of on the face of the statement, parenthetically, or in the notes, where could you put it? Supporting schedule. So I could do a supporting schedule that listed everything. That makes sense? Like, for instance, operating expenses in the income statement. You get one line, most companies do one line, it says operating expenses. And then they can, if they want, have what? A schedule of operating expenses that follow the financial statements, right? Okay, and what do they list there? All the operating expenses and add them up and add totals to it, right? So you could do it with a supporting schedule. By the way, publicly held companies, do they typically do that? Nope. They show the bare minimum they can in their income statement and balance sheet and go on with their lives. Do you suppose for internal use there might be those supporting schedules? Absolutely. They just don't have to give them to the outside, so they don't, right? So disclosure tends to be the least amount we can do and still meet generally accepted accounting principles. Is that full disclosure? Yes. By definition, you gave them everything they need. Otherwise, GAAP would have required that you give them more, right? Okay, so it's kind of like that. So anyway, yeah, number of shares of stock outstanding. Could that be on the face of the statement or in a note? Yeah, sure, so examples. And when you start having numbers in there, yeah, I'd agree to be a separate note, okay? You know what the real rule really is? If the financial statements get really cluttered, they get too long, get too much stuff all over them, what do? Put it in a note if it's short, put it in a supporting schedule if it's long. Sound good? That's kind of the rule of thumb, okay? So if you're doing privately held companies, you'd probably have those supporting schedules because you're handing to the manager of the company too, right? You're helping, okay? Get the statements together. For public, it's a different issue, right? There, it's what you're going to give to your shareholders. Internal management already knows. What do you bet that at Young Brands, they can prepare their own financial statements? They don't need an outside auditor, right? What do you bet at a real small mom and pop? They probably can't prepare their financial statements. They might be using their CPA, not an auditor now, but they might be using their CPA to help them prepare their statements. Those of you who go to work for small firms, you'll be helping small companies run their business kind of, right? Okay. Those of you who go to work for a big four firm, You're gonna be working on audits of publicly held companies or doing tax returns, okay? Right? And even then, they're doing the tax return, right? And you're giving consulting services, right? In a big company, right? Publicly held company. In a small company, you're gonna probably actually do the tax return for them, right? Whole different world, okay? Different way of looking at it. All right, anyway, and then alternative measures, verify as items carried at historical cost, whatever it is, whatever you need to disclose. If there's, there's a choice, right? Choice. Okay, supplementary information, right? And they talk about these, some of these are for big companies and small companies. We had a really big discussion a while back about big gap versus little gap. And what did we mean? Big companies, should they have different accounting principles than small companies? Where did that one come down after reading this chapter? Where did it come down? What's that? We don't officially have big gap and little gap, but are there differences for small companies, privately held companies, and publicly held companies? Yeah. Differential disclosures for large companies, right? There are requirements for disclosure that don't make any sense for small companies. So you don't have to do it for small companies, is the idea. I think that's a real good move. It's kind of silly, right? So you're either violating gap or you're giving disclosures that are expensive to get and don't mean anything to the user of the financial statements. That did not improve, right, the readability of the statements, the usefulness of the statements. That's all. Okay. And then other information. So what we've got is the basic statements, okay, existing FASB rules, financial reporting. Oh, what's this? Management discussion and analysis letter to stockholders. By the way, if you're doing an audit later when you do auditing, if you're doing an audit, are you responsible for what's in the management letter? Management discussion and analysis? Or in a letter to stockholders? If it accompanies the audited financial statements, the answer is yes, but you don't audit it. You read it, and if it conflicts with what's in the financial statements or it conflicts with your knowledge, right, of the situation, of the facts of the situation, right, you're responsible for getting them to change it because it's attached to those statements, right? So when you go out online for a publicly held company, you'll see management discussion analysis right next to the audit report, right? Actually, theirs comes first and we come later, okay? But we're right next to the financial statements, huh? So if they say things that are just directly contradictory to the statements, or they're saying things are going to happen in the future that you already know didn't happen, or really are unlikely to happen, should you take some sort of action? The answer is yeah. Okay, so you read it for reasonableness. But if they're predicting a really good year, are you going to say, no, they're not going to have a really good year? I have a different opinion. No, right? Unless you have a basis, right? Like, they're already tanking this year and the year is partly gone. Okay, something like that. You might need to tone it down. Okay, and so that's covered in financial reporting, and all the rest of this stuff is everything that's out there, right? So other information, discussions of competition, order backlog in SEC forms, analyst reports. The analysts are reading the statements and looking at everything that comes out from the company. Those reports are out there. News articles about the company, any press releases the company puts out, right? All of this stuff we don't really have anything to do with, okay? You're not going to have anything to do with it if you're the auditor, and if you're the internal accountant, you'll probably be supplying information to these folks, right? If you're working for the company. But it's, they wrote the story, you didn't write the story. It'd be nice if you could write the story sometimes, but probably not going to get to do that. That was supposed to be funny, but okay. Anyway, I like to write our own stories. All right. So are there more and more disclosures all the time? Yeah. Is there better and better disclosure as a result of that? I don't know. We keep adding and we rarely take anything away. What do you guys think of earnings per share disclosures? You took a look at earnings per share disclosures, right? How long is the earnings per share on some companies? Close to as long as the income statement. Real valuable? What is earnings per share? What do you do? Okay, you start with net income from continuing operations, right? Which might be only one line and there's nothing after it, and it's simple for a small company, it would typically would be. Divided by what? The weighted average, right? Weighted average number of outstanding shares, right? That's it. Okay, you divide it in and you've got it. What happens if there's anything after net income? You got to show each one of them, don't you? Right? Oh, and then you have to show what? Undiluted and fully diluted for everything too. So who uses this stuff? Exactly what could you use earnings per share for?
You could take the number of shares you own times the earnings per share and find out what your share of the earnings were. Okay, on the face of the statement, does it show outstanding shares? Yes, right? Typically on the face of the statement or in the notes. If we did not give you earnings per share, could you calculate it? Yeah, real close. And then could you take it times your number of shares? Yeah. Or could you look at what percent of the company you own, you know, your number of shares divided by the outstanding shares, and take that times the net income, find out what your share of the net income is? So why do we have all this earnings per share disclosure then? We never challenge it, do we? It's just what it is. We do it. So we do it. There were people who said they liked this stuff years and years and years ago. How much value is it? How much additional useful information is given to somebody for analyzing the statements or utilizing the statements? There are some ratios that use earnings per share, right? Well, earnings per share is a ratio, right? Oh, price earnings ratio. It's handy, isn't it? Is that a good ratio? It's not too bad. If you know everything that's behind it, right? It's not too bad. What are the two pieces in a price earnings ratio? Market price, which is current price, and per share. And earnings per share, which is a historical measure of what happened. Let's see, current market and historical measure. Now what do you think? It's still better than nothing. Still better than nothing. Not a great ratio, probably. Right? How many things go into making up the market price? And how many things go into making up the earnings per share? Wow. But still, it's an interesting ratio. It's okay. A high PE ratio, is that good or bad? A low PE ratio, good or bad? I don't know. Depends on everything that's behind those. What could a really low PE ratio be? Price is low relative to earnings. Company's tanking, right? It's going down. Market just hasn't figured it out yet. Bad news. What it could be the other side of that? Nobody discovered it yet. It's going to take off. You mean it could be really good news or really bad news? Yes. That was a low one, right? How about a high one? Same thing. Could be really good news, could be really bad news. You got to know what's behind it. So I'm not sure what additional stuff comes from this. Plus, could you get price earnings by looking at the total market cap? What it's capitalized at, right? Which is all the shares, the outstanding shares times the market value per share. Could you get total market cap and take net income and get price earnings by using those two things? You don't need it per share. It's silly. I don't know why that's there. I've never understood why it's there. It's been there for my entire career. And we kind of added to the disclosures too. Because apparently analysts like to use it. Are we just wasting space on the statement? Might it be better if you gave more detail in the income statement about what your expenses were and where your revenues came from? Might that be better use of the piece of paper? I don't know. You guys are the future of the profession. How long does it take to change any of this stuff? Oh my God. Oh my God. Yeah. Everybody's got to agree, right? So interesting. Yeah. So as we increase it, well, we think the business environment gets more and more complex, and I think that's probably true. I think, you know, that at least it gets bigger and bigger. Businesses get bigger, right? Necessity for timely information. Now that we have computers, could we do financial statements on a daily basis? Could we generate daily financial reports, daily financial statements? Of course we could. What would be the big problem? It's expensive. What would be expensive? It's not adding up all of the transactions. That's cheap. We're doing it all the time anyway. You could have a computer program that automatically generated a financial statement every day for any company, right? You could do it. But what's the big thing that's missing? All the accruals and deferrals. Imagine how expensive it would be, which is a lot, right? Change the net income dramatically. Imagine how expensive it would be to, on a daily basis, continuously put in estimates of your accruals and deferrals. So we're not state of the art enough yet to do that. But people want them more and more often. Is monthly often enough? Well, actually, for public companies, is quarterly often enough? Or should they be monthly? Let's go there first. Should companies be issuing monthly statements? Required to? I don't know. Maybe. How about daily? Weekly? What would people really like to have? More information on a more timely basis, right? What's the good trade-off typically? quality of the information, right? You bet. Quality of information and what else? Cost, right? So quality is on the benefit side, right? Is it any good? So you can get it fast, which makes it more relevant, right? But not more reliable, faithful representation, say, right? Nowadays. Okay, I don't know why they changed that. I like reliable better, you can count on it. But faithful representation, you can count on it too, right? You count on those numbers. So we're trading off those things. So you got cost benefit and you got reliable, right? Versus faithful representation. So yeah, so timely would be better. Accounting as a control and monitoring device, more feedback on a continuing basis, sure. Okay. So anyway. Differential, big gap versus little, mentioned a little bit. FASB has traditionally taken the position that it should be one set of gap, but we don't really do that anymore. Right? There are some big exceptions. FASB is working with an advisory committee to explore ways that its standards can be more cost effective for all companies regardless of size. So, you know, what does that mean? For small ones, probably less gap. For bigger ones, probably more gap, depending on what users of the statements need. What's the big difference between a publicly held company versus private in terms of closeness of the owners to the operations? Imagine a privately held company. What typically happens? The people who own the company also run it, or they're at least on the board, right? They're there, right? Okay, so can they get information when they want it? Yeah. How about a publicly held company? A lot of the investors, all they have is the financials, right? If you get big enough, maybe you get on board, but you have to get really big if you want to be on the board of General Motors. You have to have a pretty big chunk of stock, right? It's not going to happen for most investors, right? So then is public information more important for them? Yeah, probably so. Should they have more? Yeah, probably so. I think so. Okay, so that's what that's working on. The IFRS allows different accounting rules for small and medium-sized entities. We do less of that, but we do some of it, okay? Saying you guys read this, right? Quantity versus quality, good stuff. So, oh, by the way, Catherine Shipper, I met her really early in my PhD career. I was a PhD student at University of Oregon, and I got to go to this consortium, which was very nice. Price Waterhouse, probably. Anyway, I think that's what it was. That's terrible. I had employed. Anyway, they paid for PhD students, one from each school in the country, well, a research school in the country, to go. And we met these big shots, and she was already a big shot way back then. And we all got drunk together. And she told me that she was never going to ever publish anything that I ever wrote, which she hasn't. It's the Accounting Review, and she's was at the University of Chicago. But it was because I disagreed with her. She was kidding, I think. But anyway, yeah. So, a remarkable woman, anyway. So, what does this thing say? What's the deal? What's the SEC want to do? You guys read this? Take a look at it. You're memorizing everything. Indeed, the SEC Committee on Improvement in Financial Reporting recommended the development of a disclosure framework that integrates existing SEC and FASB disclosure requirements into a cohesive whole to ensure meaningful communication and logical presentation of disclosures based on consistent objectives and principles. Eliminate redundancies, provide a single source of disclosure guidance across all financial reporting standards. Okay, so what are they suggesting there? One set for everybody, but coordinated. The FASB and the International Accounting Standards Board have responded to this recommendation by initiating a project with the objectivity and primary focus of improving the effectiveness of disclosures and notes, okay? People are constantly working on this. If you are a good writer, you will be asked to write notes probably. And what I would recommend you do is don't use any words in your notes that a reasonably informed financial statement user would not understand. Try to avoid jargon. Don't sound important. Plain, simple English. If you could make it so a first grader could handle it, good for you. Shoot for third grade, maybe fifth, right? Don't try and be intellectual with notes. And have you guys read some of them? You have now, right? Who wrote those things? What's wrong with those people? Right? Plain, simple English. And that's really what they're going after is, geez, can we make these things understandable to a normal human being who might be investing their money, right? And still give them the information they need. What do we tend to get wrapped up in? You read the notes. All kinds of data and very little information, right? Number after number after number after number, and no real context for anybody understanding what the hell you're talking about, right? It's not supposed to be your opinion, it's not subjective, but it ought to be real clear and real understandable and condensed enough that somebody could actually use it and understand it. Remember, you're not talking to a bunch of accountants. We had a fellow go through here that John Escosa, you ever hear of Escosa? People around here talk about Escosa sometimes. He was the gold medalist in the nation, got the highest score in the nation on the CPA exam. So our president at the time was just thrilled. There was a billboard with his face on it. I'm not kidding. So if any of you want to spend a year of your life and do that for us, that'd be wonderful for our reputation. So yeah, but nice kid, but oh wow. We were in the MBA program. He did the MBA here, double county MBA thing. And so John's in there, and he's making a presentation to his class. And I'm sitting there, right? County class. I'm sitting there, and he's making the presentation, and I'm listening to them, you know, and listening to him, and I sort of understood what he was talking about, pretty much. I'd read most of it, you know, and everybody else is going right over their head. And they're all sort of looking at him with a glazed look on their eyes like they always did when he was talking. And he went to work for a big four firm and did extremely well, I hope, because he's doing really well in his career. But we got him to tone it down a little bit. Finally, I stopped him after about 10 minutes. I says, John, who the hell are you talking to? He says, what? Well, all of you guys. I says, really? Well, let me ask your audience. How many of you know what the hell he's talking about? Nobody raised their hand. Nobody. I says, you know, I'm picking up most of this stuff, you know. I think a little reading, you know, on some of the stuff you've read that I haven't read yet, I could probably understand that too. But then I have a PhD in accounting. Your clients all going to have PhDs in accounting? Really? Who are your clients going to be? Not you guys. You're not going to be your clients. Who are going to be your clients? Our business majors. Our psych majors. Got it? They're going to be your clients. Are they going to know what the hell you're talking about? And not just in financial statements. How about when you actually talk to them? So don't do that. What makes you valuable? What can you do for them? You could interpret. We are interpreting financial information. We're taking all these transactions. Remember, most of the people that are reading financial statements do not know that debit means left and credit means right. They don't know that, but they do know how to read words. They do know how to read numbers. And if you explain it clearly, they could actually know what you're talking about, right? They're not dumb. They just aren't educated in terms of finance, right? And accounting. You are now. So remember that. Don't degrade what you think. I don't think it's a big deal that you know what you know. I don't think it's a big deal that I know what I know. But don't pretend you don't know it, okay? And don't try to impress somebody with what you know. Nothing is less impressive than that, right? Don't do it. Don't do it. Don't do it. Don't do it when you write either. So if you're a good writer, please write the notes of the financial statements for your firms, right? And keep them really simple. Clients love it when I do that. And it's, wow, I never knew what that lease note meant. Now I got it, right? Yeah, no big deal. And the bankers would laugh at it because they could read it either way, right? Didn't care. Okay, those were with small clients. With big ones, who cares? Everybody knows what they're doing is reading them, I guess, sort of. Okay. Notes that means of amplifying or explaining. Sure, company should present accounting policies, a statement identifying accounting policies adopted. Should present disclosure as either the first note or a separate summary, which is still going to be the first note. It's preceding, so it can show either way. I've actually seen that as a question on the CPA exam. What number is the summary of significant accounting policies? Either not numbered or number one. It's always first. Okay, it needs to be there first. I guess it's important. Okay. Okay, common notes, yeah. Anything that is an extremely material number where you're making all kinds of different decisions or where you need more detail, right, is going to have a note. So will you always see an inventory note? Not in a service business, but in a manufacturing business, yes. In a merchandising business, probably. Okay, there's going to probably be some numbers to show. Property, plant, and equipment, you're probably depreciating it, right? Gonna have a note for that. You might have the detail. It makes your balance sheet really clean if you just show equipment net of accumulated depreciation, building net of accumulated depreciation, maybe in land, and you add them up. Maybe you show that much. Or you could just say property, plant, and equipment net of accumulated depreciation, one number if you want. If the balance sheet's getting long. And in your notes to the financial statements, you can show all the different categories of depreciation and all that stuff, right? Really nice, okay? Or again, what if you have a whole bunch of pieces of equipment and buildings and stuff, probably a smaller client, that you want to show? Use the supporting statement. It's fine, okay? Any detail you want. Creditor claims, equity holder claims, yeah, anyway, contingencies. These are real common, so you ought to know what these are. Certainly if you do a change in accounting principle, you ought to have a note on it. What do you bet will have something on deferred taxes, pensions, and leases? You look at those footnote disclosures. If you have a pension, you are going to have a pension note, right? If you have leases, capitalized leases, you're going to have a lease note. What if you only have operating leases? Disclosures are pretty simple, aren't they? I mean, you still might, because you can show the total amount of your lease stream, right? Even with that, okay? Why would you show fair values in a note? Because in your financial statements, you use historical costs. So if you want to disclose fair values, where would you do it? In the note. What if in your financial statements you show fair values? What do you probably show in a note? Your historical costs, so people can have both of them. Why not? Okay, so sure. Okay. Annual reports, more pages but better. This is just what we were talking about. Often no disclosures are needed to give a complete picture, sure, right? Required disclosure on debt, triggers that may be buried in financing arrangements. Okay, so yeah, you could find out reason Enron crumbled. Well, probably because they had no assets and they had lots of debt, and they made it look like on their financial statements they had assets. They were worthless, and put the debts off on a special purpose entity. So theirs is far beyond footnote disclosure. But anyway, but few Enron stockholders knew about the debt triggers until the gun had gone off. Companies are also disclosing more about their bank credit lines, liquidity, and any special purpose entities. Okay, the latter were the major villains in Enron. So yeah, we get some better disclosure. Okay, things companies bury in their SEC filings. This is interesting. As the editor of the site noted, some companies are being dragged kicking and screaming into plain English to tell people what's really going on. So make an effort to make full disclosure really be full disclosure. Telling people everything they need to know. Not using it to hide people like that, or hide things. Okay, related party transactions. Why is related party transaction really important to disclose? In fact, what you'll do is your accounts receivable, you show trade accounts receivable separate from related party receivables. Any related party revenue that's material, you disclose separately. Any related party expenses, you'll disclose separately. Any related party debt, right? You'll disclose separately. True? Okay, you got to determine who's a related party and disclose it. Why? What could happen in a related party transaction? They might not be arm's length transactions. You and I have a lot of investments in common, and we agree that we'll share some of our wealth in one entity separate from another entity, and we'll make this other entity look like it's far more profitable than it really is, because nobody's looking at the one. So the other one. That's what special purpose entities are. You could transfer your assets to whichever company you wanted, like a publicly held company, you still can. And you could transfer the debt to the privately held company, and nobody would see it. Special purpose entity. That's what Enron was. And they violated the rules, but even within the rules, you can do a lot of this. You can make your balance sheet look better, right? It's kind of like the leases with the off-balance sheet financing, right? So is it okay? Well, it follows GAAP, right? What was really interesting with the Enron fiasco is you could have the vast majority of the company be controlled by someone other, or you could have the vast majority of the company be theoretically owned by someone who didn't control anything, right? Go ahead.
I was gonna say, at times, didn't they have like shell accounts where they'd like push like millions of dollars in their liabilities over to another account? Like,
Well, what you do, you'd sell things from yourself to yourself because you had the control, right? you had outside ownership of 3% in those days, and now I think it's 5%, because it got a lot tougher. If you have outside ownership of that, that's supposed to keep you honest, if you have that much, because they theoretically could get damaged. And so what you've got is you have this outside interest that then takes all the risk, theoretically. What Enron did was those people weren't even independent. The financial vice president and the controller of Enron were the outside 3%, right? Well, that's not outside, they're still related parties. So they violated both the intent and the letter of the rules. But if you can find somebody who will invest 5% in the business, you can transfer all the losses to them and all the debt to them. It's really simple. You just sell them things at a huge profit for you, right? You put the profit on your books, you put the equity on your books. They have a payable to you, you have a receivable from them. Of course, it's not collectible. So if you have a receivable, it's not collectible. You have revenue? No, but, oh, and then what Enron did was they guaranteed all the debt of the special purpose entity. So the special purpose entity owed them a lot of money, and then Enron guaranteed the debt. And you know what they put up as collateral for guaranteeing the debt? Enron stock. Get this, so I have a major receivable. Without it, I'm bankrupt, right? A number of them. I've got a major receivable that is guaranteed by me, to me, backed by my stock. What happens when people find out about that, ultimately? What happens to the value of your stock? It becomes worthless. So then what is it backed by? Nothing. So it's a receivable that doesn't exist, backed by stock that has absolutely no value. Yeah, that's how it works. And we still do it. It's still okay. Because remember, the special purpose entity is not consolidated with anybody, and it is not audited. But the company is audited. They're showing the profits and so on, right? So this related party is really critically important. You can set up a subsidiary and transfer to the subsidiary. Well, you don't want it to be a consolidated subsidiary, but you can set up a special purpose entity or an affiliate, transfer all the losses to them, right? All the debt to them, keep the assets yourself, keep the gains yourself, and you can look really, really good, right? So, and should Arthur Andersen have found out about all of that? Yeah, to some extent they did know about it, if they thought it was within GAAP, you know, and so, yeah. What's really sad about it is there was a lot of debate. The SEC wanted to close down the special purpose entities, still would like to, and not make you have a really substantial interest before it's a separate entity, right, from outsiders, instead of just 3-5%. Okay, they really, really wanted it to be big, right? But anyway, at the time, Arthur Andersen and the other big six, I guess at the time, wanted to, they were debating over it, and some of the firms really hated special purpose entities, some of them really liked them. Guess which side Arthur Andersen was on? They wanted to get rid of them. And guess what probably brought down Arthur Andersen? Special purpose entities. Not that it's not their own fault, right? Because people really got carried away. You know, even violated that. But they didn't want them to exist at all, right? And then they ended up coming down. So GAP's an interesting thing. It's real political. Okay, anyway, so we disclosed the nature of the relationships involved. By the way, it can be an arm's length transaction. You know, I hire my daughter, who's an attorney, to be legal representation for the company. Should we tell the shareholders that? Yeah, it's a related party, right? I'm president of the company, I'm running the company, right? I'm on the board of directors probably. Should I let them know that our legal counsel is my daughter? Yeah, sure. Might she be getting normal fees? Sure. Is that all right? Yeah, it's no problem. But what does this do? Or, you know, you're one of our shareholders and we loan you a whole bunch of money. Is it okay to loan you money? Might be arm's length transaction. You might have the wealth behind it. You might give us all kinds of collateral. You might be paying market rate. We hope all that's true, right? Otherwise, it's compensation to you, right? Okay, so yeah, but should we tell all the other shareholders? Yeah, just so they can evaluate it for themselves. That's all it is. What if your related party is you've got one customer? Should you tell people you've only got one customer? Yeah, I think so. You probably should. What happens if you lose the one? You're in big trouble, right? What if they owe you a lot of money? You know, all those kinds of things, right? So sure, you know, so that's what it is. A description of the transactions for each of the periods for which income statements were prepared. We haven't really done very much with this related party stuff, have we? Right? So they're trying to throw it in, okay? And it's big. Dollar amounts of transactions for each of the periods for which income statement are presented. If I have income and expenses from related parties, I tell people about it. That's all, okay? And the same thing with receivables and payables or investments in them or so on. Amounts due or from, there it is. Okay. So, and then obviously we want to disclose errors we made. If it's a correction of an error prior period adjustment, you think you'd have a note to the financial statements? Yeah, duh. Okay. Fraud, right? Well, if there are instances of fraud or illegal acts. By the way, do we do illegal acts on purpose? Yes. What's a big example of illegal acts on purpose? Yes.
Environmental, like fines, like.
Well, maybe environmental fines, although I don't know if we did it on purpose, but if we did, right, yeah, or sometimes feel like we changed the law after the fact, and now you're in violation of the law. You didn't think you were, now you are. Lee Thomas, he used to be executive in residence here, has some really cool stories about that, where they'd buy a company, the CEO for Vermont American, and he bought a company up in the Northeast, and he found out that they owned a whole bunch of land that was contaminated, and he had to get rid of the contamination, and he didn't know they had it when he bought it, and boy, was that a big cost, and you don't want to disclose all that, but it wasn't really an illegal act on his part. It wasn't an illegal act on the predecessor companies. It was legal what they did at the time, the dumping they did. You had to clean up the mess that you made after the fact, right? Superfund sites in Indiana, boy, there's tons of them, right? Indiana's got a big problem with superfund sites. Contaminated soil, they can't ever be used for anything, for who knows how many years, and they have to try to clean up, but there's no way to clean it up. So he dealt with some of those things. But the illegal act I'm thinking of is bribes. Do our airplane manufacturers pay bribes? Yes, they do. Otherwise, they don't do business in a number of countries. Africa's big. The Middle East is big on bribes. Some countries in Asia still big on bribes. Is it against U.S. law to pay bribes? Yes, it is. Right? Foreign Corrupt Practices Act. It's illegal. What do you have to do if you pay bribes? You have to disclose them in your financial statements that you paid bribes. Then you have to pay a fine to the government, right? The U.S. government, and then you have to disclose that to the IRS as not being a deduction, right? You don't get to write illegal acts off in the tax return. So the bribes cost you the bribe, and you have to disclose it, and you have to pay fines, and both the fine and the bribe is not deductible in your tax return. Why do they pay the bribes? Because they want to sell aircraft. It's included in the purchase price of the airplanes, of course, right? But it's all, every culture isn't as honest as we are. I don't know, that might be a statement, right? That we're honest, at least we have organized, right, legalized ways of getting money out of people. Okay, so we don't do it with bribes. So I think that one's kind of fun. So you'll see financial statements. They're kind of fun to look at a financial statement for an airline or for Boeing or somebody like that. You see their bribes there. Okay, so that's good stuff, I guess. Okay, so what time are we supposed to be done? Quarter to. Okay, oh, we had more time. Yeah. No lead. Okay, let's do post-balance sheet events. Subsequent events. Okay, so the deal is the financial statement period goes through year end, whatever it is, and then there's subsequent events, and there's two types. They don't call them type 1, but a lot of people do that. Type 1 and type 2 events. What do we mean by a subsequent event? It's, the financial statement period, everything that existed at the balance sheet date, we should be included in the income statement too, right? Cash flow statement and equity statement. All of this stuff, those are journal entries, right? The things we knew about. We book it. We make all of our deferrals and accruals at the end are adjusting journal entries. It's all in. What's this stuff? Events that provide evidence about conditions that did not exist at the balance sheet date are subsequent events, right? Out in here. What's this? Events that provide additional evidence about the conditions that existed. So the conditions existed here, but we find out about it later. Type 1. Type 2 is what? It hadn't happened until year end. What are you going to do with those two types of things? Give me an example of the first one. What would be an example of that first one there? Events that provide additional evidence about conditions that existed at the balance sheet date. Yeah.
Like a company that owes
bankruptcy or something, they're already in trouble.
Yeah, they're already in trouble. At the end of the year, you might have known they were in trouble, or maybe you didn't know at all. And then later, they declare bankruptcy, and now you know it's bad. So, this is really an interesting one. You see these things a lot. Was it good at the end of the year and then it turned bad, or, so that's a transaction, an event, not a transaction, but an event, or was it bad the whole time? Was it bad from the time that you sold it to them, or only bad from when they got in economic trouble? When was it bad?
I would say it was bad when they were in economic trouble.
Well, before that it was good? So if I sold you something for $100,000 and you intended to pay me, and you had both the ability to pay me and the intent to pay me, and then you get in economic difficulty before it's due and you don't pay me, I still have a sale and a receivable.
Won't be bad.
And then, when is it a bad debt? In the period I sold it to you, or in the period that you got in economic difficulty?
I would say when you get an economic difficulty.
Is that right? It's interesting, isn't it? Kind of hard to tell. What if I'm finishing the first year and the event that causes you to be bankrupt? Maybe what caused you to be bankrupt is your plant burns to the ground. You know, you're now bankrupt. It's over, right? Okay, you weren't insured enough or whatever. You know, you don't have business continuation. You can't stay in business. So you're not going to pay, right? So, you know, it's a real event that happened, and it happens after my year end. Well, then I guess at the end of the year it was a good receivable, and it was a sale, and I should record the sale in the year, and then, you know, I'll have the bad debt the next year, right? So that's going to affect next year's income, not this year's. You guys comfortable with that? Some people would say yes. Yeah, you might be right. Okay, sure, that could be. But what's the problem with that? At the time I sold it, was it collectible? Yes or no? You're never going to collect it. What would that imply? No. But at the end of the year, you still have the capacity to pay me. What does that imply? Intent capacity. At that date, I guess yes. Yeah. So what could you do? You could just disclose that, oh, by the way, we're never going to get paid that one that we thought we were going to be paid. Or you could say, I was never going to get paid that from the beginning, and what I could do is record the bad debt expense in the current year. That's going to make a huge difference in our net income, perhaps, right? If it's a major customer. What do you guys prefer to do? What should you do? Is it adequate to put in a note to the financial statements, a subsequent event, you call it subsequent events, and you tell them, oh, by the way, you know, 80% of our sales last year didn't really exist because it's a major customer. They get a big number, right? It's extremely material. My net income's gone if I booked it. But I'm not going to book it because really the event happened the next year. So that year's income's probably gone. Bad news for the future, right? How about if your plant burns down? And that's the subsequent event. The year ends December 31st, it happened January 1st. Do you still have the income you had? I think so. Do you still have the financial statement? You do have that. Do you still have the same balance sheet? Well, you did it December 31st, you just don't January 1st. A lot of people would say, well, just disclose it. It's a subsequent event. Oh, by the way, we're not in business anymore. Wow. So you see where you get in trouble on this stuff? Okay? How about if the evidence did exist, you just didn't find it? Now you get a subsequent event where, you know, really, if you'd really dug in deep, you would have found it, but, you know, you get out here, and now's when you find it. What should you probably do with that? With hindsight, you think, you know, I really could have found that if I looked a little more carefully. What should you probably do? Book it in the current year, December 31st. Right? Don't you suppose? So it's really a lot of judgment gets involved in this thing. So anyway, they're the two types that you've got, and you've got to make those decisions. Okay, so you search for those things. Okay, so for each of the following subsequent events indicate whether a company should adjust the statements, disclose in the notes of the statements, don't adjust or disclose. Okay, so what would you do? Settlement of federal tax case at a cost considerably in excess of the amount expected at year end. They say adjust the statements. Why? Remember, you haven't issued the statements yet. If you issue the statements, it's a different issue. You have to decide whether you're gonna rescind the statements or reissue, right? It's a whole different animal. Do that in auditing. Okay, but how about just this? You know, we're the company. We haven't issued the statements yet, but it's past year end, and the settlement of the federal tax court case is done. It's on prior years, we disclosed income tax expense, right? And it was too low. We lost. We have tax and penalty. It's material. We owe it. What are they suggesting? Adjust the statements.
Would you probably put a note with it?
Probably put a note and explain what happened. Yeah, I would think you would. It's real big. You might have had a note anyway. It was a contingent liability, right? And you're estimating how much it is. Maybe you even booked it based on the estimate. What do you know about your estimate now? It was wrong, and you know it before you issue the statements. I agree with them. I think that one ought to be disclosed in the statements. Yeah. Introduction of a new product line. I'm taking a big risk, or I'm dramatically expanding the business, whatever. I'm going into new regions of the country or the world. I'm going to have new products. If I want to let people know about that, can I? Sure. Maybe I should if it's a big risk. But what would we do? Neither adjust or disclose? Could you disclose if you want? Yeah, sure, you can disclose anything if you think it's material enough, if you think it's risky enough. But I kind of agree with them on that one too. I don't think I'd do either one with that thing. Right? Judgment call. Loss of assembly plant due to fire. What did we suggest on that one? Happened after year end. Put it in the notes, right? Okay, so yeah, that's probably true. Sale of a significant portion of the company's assets. Now this might be a discontinued operation, but the decision to get rid of it is next year. What if your decision was this year to get rid of it? Now what do you have? Now you have a discontinued operation, right? You'd have to project what your gain or loss is going to be. If it's a gain, you would not book the gain. If it's a loss, you'd go ahead and book the loss, wouldn't you? Your estimate of the loss from wrapping it up and selling it off. If you decide to do it before year end, right? It's the date you're going to measure. If you decide to do it after year end, which is what this is implying, what would you do with that one probably? Disclose it in the notes of the statements, right? Okay. Wouldn't book a discontinued operation. Okay. Retirement of the company president. Probably do neither one, right? Do people need to know about the retirement of the company president? Yeah, probably, but would it be something that you put in the financial statements? Probably not. I'd agree with that. Okay. How about this one? Issuance of a significant number of ordinary shares. Now, they think that one should be disclosed. We would not put it in the statements. If you put it in the statements, it's going to change all your earnings per share, right? Well, except it can't because they weren't outstanding during the year. So I guess not. It'd change your outstanding shares at the end of the year, though, wouldn't it? If you booked it, I don't know how you'd even book it. But should you disclose that in the notes? They suggest you shouldn't. But do you think so? How is that important? I guess for future years it's going to affect your earnings per share. It affects who's controlling the company. Is that more important than the retirement? How about if it was the death of the company president instead of the retirement? Retirement is sort of in the normal course of business, they replace. How about it was the death of the president, and it's a real small company, and they're critical to the profitability of the company, or they're president of Apple, and they die. Does that go in the financial statements? Maybe, right? If they're significant enough to the business, you could, right? So anyway, I think they're kind of interesting. Not any real answers on all of that stuff. How about a loss of significant customer? Neither one? How about it's your only customer? Well, hell, I don't know. That's a different story. Prolonged employee strike? Neither? What if it puts you in a position where you might not be a going concern? Yeah, probably on both of those. That I might put in the notes. And no journal entry probably though. Material loss on a year-end receivable because of a customer's bankruptcy. Your suggestion, right? So what happened to them was in the next year, they want you to adjust the statements, right? For a material loss on a receivable, year-end receivable. I've seen it the opposite way though, when they did have extraordinary items. I've seen extraordinary items be loss of a major receivable. I can never understand how that would be one. How is it both unusual and infrequent? Hopefully it's infrequent for you, but it's not unusual for businesses to have bad debts, right? But here they suggest, and this is the author's opinion, right? that a material loss should adjust the statements, but big losses from losing a significant customer, although that's, I guess they already paid the receivable and now you lose them, in this case, must be. Or a prolonged employee strike, neither adjust or disclose, I don't know. I might think you should disclose those in the notes. If it's affecting the future viability of the company, I absolutely would put it in the notes. Wouldn't you? Okay? So, and I kind of like the idea of a year-end receivable. If they went bankrupt later, I don't think it was ever collectible if it never gets collected. So I disagreed with you on that one, right? Yeah, fine, I'll wait until the next year. I'm kind of more, nah, I'll go ahead and book it. I don't think it's a bad debt expense in the future. I think it's a bad debt expense when you sold it to them. Now that I have a crystal ball after the fact and I can see it, I know it was worthless. But then you can see it the same thing. How about if I bought a piece of land? No, I guess this does apply. I bought a piece of land and it gets condemned. I find out it is a Superfund site, right? I bought it, paid money for it. And now I find out I can't use the land. It's now worthless. What happens? When do I write it off? In the year I bought it, of the loss, or in a subsequent year when I find out that it's a Superfund site? When do you have the loss? It was a Superfund site when you bought it. You guys just made a bad decision. I think you should have the loss in the year you bought it. You should write it off. These are tough issues, though, right? Kind of hard to come up with. So I'd go either way. Hiring a new president, I guess, goes with the retirement of the old one. Settlement of a prior year's litigation. If you settled it, what should you probably do? Book it, huh? Now it's probable, right? And it's estimable. So I agree with that. That sort of goes along with the loss on a receivable, okay? Merger with another company of comparable size significantly changed how your operation is going to be in the future. I agree with disclosure. So anyway, a variety of those. Reporting on diversified companies. Investors and investment analysts want income statement, balance sheet, and cash flow information on individual segments. Now this is interesting. What are you supposed to put out for segments of businesses? This is going to be for large corporations where they actually have segments of their business. In a small company, you might have just one line of business and that's all you got, so you don't have to worry about segment disclosures. So this is kind of big gap, little gap, based on how big the company is. But what should you show for each? Here's a consolidated company and they have office equipment division and they have an auto parts division, okay, right? Or maybe they're subsidiaries, right? Okay, parent subsidiary. What do you need to show? What information is supposed to be shown? The SEC wants you to disclose the information you use for internal decision making. What does that mean? For somebody like Young Brands, what does Young Brands have? Primary things they've got. Restaurants, but they're different restaurants, right? Identifiable segments, very easily identifiable. What are they? Taco Bell, KFC, Pizza Hut, right? Are those in different businesses? Yeah, they absolutely are. Okay, different market segments, right? Different price points, different types of stores. They're really different businesses. If you were competing with Pizza Hut, would you like to know how Pizza Hut's doing? You're Papa John's. Would you like to know what's going on with Pizza Hut? Can Young Brands tell what's going on with Papa John's? It's a publicly held company, you guys. Their statements are out there. What lines of business is Papa John's in? Pizza. What does Young Brands do? It's all combined together. Got the idea? Okay, for their other ones, their chicken business, right? KFC, are there competitors in that business? Absolutely there are. Would they like to know what KFC looks like separate from the rest? Yeah. So what does the SEC want you to do? They want you to give them the information the way that you make decisions internally. Wow, that's interesting. A lot of companies have come up with, oh, well, we'll tell them how we're doing geographically. So, by regions of the country, here's what our total sales are, here's what our total expenses are, here's what our income is for each area. What does that do for somebody to compare your three business lines in the case of Young? Not much. But they can say, well, look, that's how we run the business. We do it regional. But here's where and I don't know that they do that, but what happens is businesses don't necessarily, a big scandal kind of going on now. controversy. Businesses do not seem to want to disclose the information they use for making their internal decisions. They like it all being in one. So when they do partition it, right, into segment disclosures, what do you get? Pieces that aren't really very useful for interpreting what's going on in the business line. And when you're out there, guys, you need to fight that, right? It's supposed to be disclosing what's going on with the segment. The other thing is, how much information do you actually have to put out? This looks like it's huge, doesn't it? Look at this. This is good. Sales, all the manufacturing costs, all the selling and administrative costs, so cost of goods sold, right? All the selling and administrative costs, and then income. You know, you look at that, and what does that look like? Oh, they're really giving disclosure. Do they really put all those lines in necessarily in segment disclosures? No, right? They might give you the sales, they might give you the income, and that's all, right? And you could then calculate what expenses are in total. But can you analyze what's going on with the business with that information? Nah, not particularly. Okay, so this is an interesting area. Anyway, see you guys. What's that? Oh, you gotta shut it. Look at all the writing I did over there. I don't know. When you touch this side, it writes on that side. Yeah.
Can you read that?
It's not a letter, is it? You'll get it. I apologize.
I know, that's the
Are
only
they,
thing
are
I'm
they
waiting
done
for.
again? I'm the last one.
Yeah. Can you, this is
Oh, good. That's cool.
do you,